Africa, the continent that pollutes the least, is today one of the world's most vulnerable to climate risk, as countries across the continent grapple with debt issues and financing constraints when it comes to dealing with the impacts of climate change. To combat climate change and support green growth, African countries need more climate investments to achieve their national targets for emissions reduction and climate adaptation. In this special report, Perpetua Fasanmi-Peter takes us deeper into what climate financing means for the continent.
Increased cyclones, more frequent and intense droughts, forest fires, lower food security, and reduced productivity in agriculture are some of the risks and impacts of climate change that are being felt across Africa. To mitigate these environmental issues, vast, multi-level and cross-sectoral scaling up and acceleration of climate mitigation and transformative adaptation are imperative. So, how can African countries achieve debt sustainability while meeting their climate financing goals? Let's look at what climate finance entails.
We have seen flooding in recent years in Nigeria. Last year, the World Bank estimated that over $6 billion, was wiped out from the Nigerian economy because of the flooding that happened last year. And so many other typical examples like that have happened or are already happening in recent times. So what do you think will solve these problems? Financing. So if there's any continent that requires this financing, it should be Africa.
The majority of African economies qualify as emerging markets and developing economies, or EMDEs. EMD's external debt levels and service payments have more than doubled since 2008. Between 2008 and 2021, sovereign debt for this category increased by 178% from $1.4 trillion to $3.6 trillion. This has largely been blamed on the effects of the COVID-19 pandemic, the Russian war in Ukraine, and global economic headwinds.
We have to remember that the debt levels were already increasing even before the pandemic actually hit. Now, the impact of the pandemic has been severe, of course, as you're well aware, and countries are also witnessing far lower than expected economic growth rates. Now, to add another major shock to the system has been Russia's war in Ukraine, and that has led to high energy prices, high food prices, and of course, inflation has gone up, and countries have increased their interest rates in order to combat inflation, which has remained pretty stubbornly persistent. What this means is that countries are now paying a larger fraction of their revenue, paying down their debt, and that means that they have less cash available on hand to pay for more productive investments that would help them reboost their economic growth rates.
Urgent action is needed to immediately help EMDEs restore debt sustainability and mobilize resources to achieve shared development and climate change goals. Initiatives like the G20 Common Framework are yet to engage all creditor classes or link debt relief to climate and development.
Now, the G20's Common Framework is also not equipped fully with the instruments that it would need to be able to offer carrots and sticks to bring creditor classes, all creditor classes, to the table.
Climate vulnerable countries have some of the most significant debt distress and are currently facing climate-induced losses. For 61 countries identified as in or at high risk of debt distress to achieve debt sustainability, more than $812 billion in debt needs to be restructured across all creditor classes.
Looking at the existing agreements and accords, Africa is most likely to get that finance. I don't know if you've heard of $100 billion goal. This started all the way from 2009 in Copenhagen, Denmark, where we have the Copenhagen Accord. Then we moved from Copenhagen Accord of 2009 to Cancun Agreement in 2010. Then this cumulated to Paris Agreement in 2015. And what does $100 billion goal represent? That the developed nations are going to muster or going to crowd $100 billion and spend it in developing nations or send it to developing nations every year for climate action mitigation. So will Africa get that funding? Yes, we can. But if Africa does not get the funding like you asked, what can we do? Then we can catalyze this funding within Africa.
How can emerging market and developing economies find financial and fiscal stability while making the investments necessary to transition to sustainable and low-carbon economies?
The common framework has not been able to deliver the kind of debt relief that really needs to be delivered and that it really needs reform. And so the first component of this is that there has to be comprehensive debt relief by public creditors, private creditors, as well as commercial creditors also need to come to the table, whether through characteristics. All creditor classes need to be compelled to come to the table so that they're able to make sure that countries are able to access the debt relief that they need to. Now, instead of this, that countries don't actually teeter over the edge, there has to be a far more scaled up mobilization of finance, ways to enhance credit so that countries continue to remain able to access concessional resources to make the investments that they really need to.
What of concession loans? What of guarantees? What of grants and innovation and the other innovative kinds of funding? These are ways we can actually achieve this funding. These are funding structures. Lately, we are seeing a lot of people, a lot of governments and nations, keying into the multilateral fundings from multilateral agencies like the World Bank, IFC, IMF. Some of them have designed some beautiful structures in terms of funds that, take advantage of blended finance. What do we mean by blended finance? Take finance, or call it mixed finance, mixed financing structures. You get a low priced capital, high price capital. By the time you blend them, you have something reasonable at the middle in terms of cost of funding. So you can get from multilaterals or DFIs, what we call the development finance institutions. We can get from normal banks.
Moving forward, however, countries should be able to choose from diverse funding options and terms and conditions to ensure they have the best of choices. Perpetua Fasanmi-Peter for News Central.